So, hello everyone. Welcome to this session. I'm very happy to have these two entrepreneurs, famous entrepreneurs, almost famous entrepreneurs, Lupina and Miguel. And I think the best way to start revolutionizing fintech is to get a brief introduction and then see what we are revolutionizing. So maybe Lupina, want to start?
Well, for the people who doesn't know what Fintonic does, in Fintonic we want to try to improve people's financial well-being. And how we do this, we give people access to credit, also we help them to save, and also what we do is to improve their financial education. With Fintonic, we have this passion so that people could really meet their own goals, but also meet their own obligations so they have a better and safer future. That's why we have deployed in Fintonic our own loan marketplace where the people can get a loan really straightforward from that, and we improve also people's financial education because, as you know, finance and education is linked to have more incomes. So that's what we do.
Thank you. Yeah. Miguel.
Yeah, hi everybody, thank you. It's amazing to be here. So I'm Miguel, co-founder and CEO at CapChase. So what we do, our mission is to help SaaS companies to grow faster with capital, non-dilutive capital, with insights and tools, right? So we started 2 years ago, it's been very, very quick, and our main product is also lending, well, like Fintonic, but we only do B2B SaaS. And why that's so important is because our realization moment was when we saw that SaaS companies, the best performing SaaS companies, were spending around 50% of their revenue in totally predictable activities, right? Activities like growth, user acquisition, and so on. So they were just sinking VC money into those activities that, at scale have a very predictable return. So what we saw is that if we offered them non-dilutive capital to fund those activities, these companies could scale much more efficiently, grow faster, have longer runway, and essentially raise money at a higher valuation. So that's what we do. And the mechanism is that we enable them to access their future revenues ahead of time. So imagine a company with $10 million of ARR, they're going to see $10 million through the door over the following 12 months. So instead of waiting, they can just access that money today, or parts of it today, to invest into acquiring more customers.
Thanks, Miguel. I think that was a good intro to see what we're doing here. So it's about lending, so lending revolution. What is really revolutionizing? So what really makes you different? What differentiates you from the rest of the market? So obviously the other fintechs which are around, and also the incumbents who are basically today have the main market share in this market, and fintech is only scratching basically a little bit on this big market. So what is really the revolutionization of specifically your approach? Okay,
well, in my case, Fintonic is your trusted advisor at the end of the day. So we are not just giving loans for the people that we do, but always think to their own credit score. We have built our own proprietary credit score so the people understand how good or bad they are for the banks, which interest rate they do deserve if they're going to apply to a loan, and what they have to do to improve it. We are the only ones giving this info in Spain. We are also in Mexico and in Chile. And we are the only ones giving this type of info, and at the same time, we have created this loan marketplace where the banks are synced. What is from us? Well, we are a data company. We have 1 billion data points. We have created the most evolved risk model, much more evolved than the traditional banks ones based on the probability of default. So we can predict if someone is going to commit fraud in the future. So we really are aligned with the people and aligned with the banks that are connected to our marketplace, because we want them to have less risk and give more loans at the end of the day, and that's what's happening, no? So all this data that we've been doing open banking since 2010, and how we have enriched it, how we have built trends, how we have categorized, cleaned it, and it's one of our entry barriers because we have been here for the most long time now, and I think that's one of our secret sources. And always, always, always being aligned with the user. We are not a bank, we are always aligned with them, and that's why we have included tools just for organize your money, and also right now we are launching, and I can announce because we are announcing it like next week, a financial program for the people, 8-week subscription program, so they can really understand where their money goes, what they have to do, how they have to change their habits, because we really believe in transparent and fair loans, and always being aligned with the people. So I feel this loop that we have closed, we are the only ones that I know worldwide right now.
I think data is really important, I would say, and this really differentiates many fintechs from the incumbent banks, because they don't make enough of the data they have. In principle, they could have the data, but they don't make enough of it. And you obviously have the advantage of not tapping into data of one bank, but of many banks, which is obviously a big plus compared to if you would just run one bank and just have the data of your customers. How do you deal with data? Because I think it's very different from basically scoring individuals like you do, and you scoring companies or SMEs or small units. How do you go about that?
I think it's kind of similar, right? So we also connect via APIs instead of to multiple banks. What we do is we connect to the company's systems. So we connect to their banking data. If they have multiple banks, we can consolidate all of that. Then we connect to accounting data and to revenue data. That can be, like payment files from credit cards directly to the source. You can connect to their history of invoices. And what we do with that is a couple of things. On the one hand, we evaluate the companies. On the other hand, we kind of like deploy contextual financing. So in the first part, we consolidate all that data. We crunch basically the numbers for the company itself, and then we benchmark them against all the thousands of companies that we've analyzed and learned to already. And then that gives us a score that determines how much money these companies can access at any given time. And then on the other hand, we'll remain connected to those companies in real time, right? So as new data is generated when they close new customers or when they make new payments, then what we do is that surfaces as trigger events to deploy financing at the most efficient point. So as opposed to an incumbent, where they would give a ton of money to the company up front, and then the company would need to decide what to do with it, we use the company's data to inject the right amount of money for the right amount of time so that they are paying the minimum price for it.
Now, that's quite interesting. I think one thing is you obviously acquiring customers for one purpose, for basically getting a loan. And people may not want to get a new loan every other day, so it's something you do, and then you do maybe a couple of years later, specifically in the individual case. How can you optimize on customer acquisition cost? Because obviously you have to acquire the customer, and then you have the customer, but the customer returns maybe in a couple of years, but maybe not. So how do you basically go after about that?
In Fintonic, the users are really engaged, and why? Because they don't come just to get a loan, also because we help them with the finance at the end of the day. Last year we saved them 21 million euros in fees because we alert them of things that's going on with the banks. We tell them that they need to have their banks under control, the insurance companies under control. So we help them to do that, and that's the way they are getting engaged with Fintonic in a weekly basis. But it's important that this is because we have built a trustworthy brand. We really fight for the people. We really are always aligned with them, no? And then see that when they come to Fintonic for a loan or just to organize their finance, they are always like talking with our fin coach, with our experts, so we can assess them on a daily basis. Do you feel this bank is better than that one? They do ask us this type of questions because we are there for them. And then, of course, we can help them with, in terms of cost of acquisition is really, really low, and we have the payback in the first month, so it's great. But then we can drive our CLTV really high also because, of course, we offer them other solutions that we think they are good for them. We are also insurance brokers, so we can help them not only save in their actual insurance receipt, but also, for example, when my third kid was born, I was like not feeling really well, and I didn't want to talk with my company. So Fintonic, on my behalf, fight for me, So as in brokers, we fight for the users. We tell the company, you have to pay them back. As we have a lot of users, we have the strength to do that type of things. And we are doing that. That's a service that the people think it brings them a lot of value, also with budgeting and also with all that type of things. But I believe people are going to be here in the future. I don't know if banks are going to, because what we were talking before, I don't know who's going to stay here, banks, fintechs, or whatever. I know people is going to be here, and they need someone to trust. So we need to gain their trust, all of us. We need to find the nudges to help them to have a better life at the end, no? And so if they see we only want to push them, it's very bad.
And with this, will you become the super app? So many people are talking about the super app. Like in Asia, we see Revolut is also displaying that they will become the super app, basically covering all your financial needs and everything, and even broader. Do you think you would also go in this direction, or is this?
But I believe in marketplaces. I believe that sometimes some people deserve, like, I don't know, a 5% API interest rate for the loan, but others not. And not all the entities have the same risk appetite, for example. So we have our own loan book, but we cannot cover all the risks. So that's why I really believe maybe a super app, not a super app, because a super app, they do everything with their own balance sheet. They do exactly everything. If you really have the strength or the possibility to, with your own book, give to each person what they do deserve, and give to everyone, or everyone that they have a pretty good credit score, then okay, we can become that. But right now, I bet more for the marketplace, where I think I could truly fulfill our users' needs that way, not only with our own book, but with all. Also, with we are insurance brokers, and we have all the companies within the marketplace of insurance.
So basically, we see these two trends. How about you? Do you see basically yourself opening up and widening the product range to basically become more efficient with regard to customer acquisition, cost, lifetime value, and so on?
Yeah, I mean, absolutely, right? I think that somebody said that there's only two ways of making money, right? Unbundling and bundling. So, I mean, every single fintech that I've spoken to, they say, we're going to start with this which product, but then we're going to do this, and then this, and then this, and then we're going to own the whole value chain, right? That's in our seed deck. So everybody says it. So yeah, I think that is the key to getting a lower CAC, bundling different products, so that, if a customer is not using your most profitable product, at least they are engaging with your app in a different way, similar to what Lupina said. So for example, how we achieve that, how we achieve a lower CAC compared to the traditional B2B lenders, 5-6 years ago, is in two ways. One, by bundling our own product, and then by building functionalities for third parties' apps, so that they can also kind of offer the same super app value prop. And then two, by the configuration of the product and the industry they work with. So on the bundling side, I mentioned, we help SaaS companies to grow with capital, tools, and insights. So the tools and insights, tools for revenue management, tools for forecasting, and insights, benchmarking against the peers, really helps us to get connected to the data, stay connected, and then when we spot an opportunity to give them funds, then we can do it without needing to spend in customer acquisition constantly. And then on the other hand, the industry, why we're so excited about SaaS, and why it's so different from all the B2B lenders from 5 years ago, is that SaaS companies, the companies that we work with, are growing at 100% year-over-year rate, right? So then they're constantly hungry for capital, and they constantly need to redeploy money into growth. So then we start working with a company today, and then we have designed the product, so instead of giving them a big lump of cash that then they need to figure out how to deploy, we inject little bits month over month. So then as they grow, they constantly draw more and more and more, so that the lifetime value for us keeps growing, and also we don't need to acquire the same customer every time.
Mm-hmm. I think what we've seen is that the data makes a lot of sense, and to make more sense of data is a huge value, and this is not basically being tackled by the banks properly, I would say. The second big thing we see here is basically that you're creating marketplaces, and marketplaces obviously is the best way for customers, be it B2C or be it B2B, to get the best conditions, and this is exactly what you're doing basically. So in the end, you're also widening the market, because you're targeting customer groups which are not served today or are hard to be served. The banks have really difficulties doing this, and I think the marketplace combined with the data makes it really accessible. So in the end, we are, with you, growing the market, basically, the fintech market and the accessibility here.
I don't believe in marketplaces for lending. I'm sorry. Like, so we had the option to choose at the beginning either to go marketplace or do our own book, with dedicated warehouses, warehouse lending, so lines of credit that the banks would give us to deploy to customers. And we chose the second one because people are like, no, marketplaces is great, there's no risk, you're not exposed, you don't hold anything in your books. It's not true, right? If there's systemic risk, then your marketplace lenders start to lose money, then they're not committed to buying loans from your book, so they stop buying, and the company crashes. And a bunch of marketplace lenders during COVID, when demand from lenders disappeared overnight, the companies disappeared, and it was fire sales, right? As opposed to a marketplace, we are direct lenders, we have dedicated warehouse facilities that are contractually committed. So as long as we originate to the companies that we have agreed to originate to with the lenders, that money is there. So we have over $500 million that are committed, are signed, and if we find the SaaS companies that meet the criteria that we have agreed, then they have to fund it. It doesn't matter if there's a competing product. Imagine like a mortgage product that offers a similar yield. The lenders cannot just switch from one to the other. They need to continue to fund. So that's why we went direct.
We combined, sorry, I want to step in because we don't have just marketplace with third parties, that here are some of them, BBVA, Santander, but also we have our own loan book. And why we have our own loan book? One is that reason, of course, but another reason is because to evolve our risk models, and right now, in these past 2 months, for example, we have really changed our last risk models that we have. You need to have your own loan book also. So, and also we are in Mexico, for example. In Mexico, our loan book there is much bigger than it's going to be here because they are growing like crazy, So we combine both, and I think the combination of both worlds, it helps us tackle everything, because from Fintonic always the user get what is best for them in terms of interest rate, and we are there with our loan book for all those rejections. Out of those rejections, we make a huge amount of money because of our models, and we prove that to the system, to the banks, and to everyone that really you can make new models based on data, not only the aggregation data from the banks, but from other sources also. That way, you cannot predict this, what I was talking about, in the past, enrich the data with the ability to understand if the people is gambling or not, and understanding how it's going to behave, because we really feel that the people want to pay at the end of the day, but sometimes something happens and they cannot. So how we can try to prevent that, and we are working a lot in this type of models, prevention in the future.
Let's talk maybe a little bit about the next revolution happening. So obviously what everybody's interested in, DeFi. So would this change your business model, or would this basically your model completely go into the decentralized world and basically mainly being built there? Do you see this happening, or do you see this in combination?
Well, maybe not in the last couple of weeks, right? But yeah, so we have looked at crypto. I'm not super bullish on crypto, to be honest, on DeFi specifically, because DeFi stands for decentralized finance, right? Which means that there's not a central body making decisions, and usually decisions are made by members from organizations. And as of today, what we see is that these distributed autonomous organizations are motivated by greed, not by fiduciary duties or by anything, right? So I think the advantages for both customers, consumers, and the people operating in crypto is that it is not regulated, so you can do all the crazy things that you could do in the real world 40 years ago, you can do now in crypto. And, well, also that there's tons of capital that need to be deployed. That means that you can get like higher yields to offer to your customers, higher cost of capital for yourself, but then it is very, very fragile. And we saw, like in the last couple of weeks, all this, the Terra ecosystem disintegrated in 3 days, right? So that can happen. I think it's bound to get regulated and then centralized as well, because these people need to make good decisions, and the crowd doesn't always make good decisions by wisdom of the crowd.
Okay. How about you, Dee?
What I believe is right now, people overall don't have education to really understand crypto. So it's not extended in the payment world at the end of the day. No, it's more for investors right now. I don't know what's going to happen in the future, but right now, what we are seeing is, with our data, is that the people, some of them are, of course, playing or investment with crypto, but they're not using it in a regular basis right now. Why? Because we are lack of education. You know, if you haven't gone to a business university, or if you are a doctor or a taxi driver, I don't care, here in Spain, Mexico, Chile, over the world, you don't know anything about finance, so you don't know the basics. If you don't know the basic, you are afraid of the new. So that's I think we have to work more in education and to bring value to the people. Do they feel a difference between what they have right now to do payments, for example, or they don't perceive it right now? I don't want to talk in the future, but that's what I'm seeing right now.
Okay, so this is not the next revolution for at least lending business as we see.
Yeah,
sorry. Yeah, go ahead.
I was going to say, like, there are some applications where it makes sense, right? Smart contracts, you know, and if this, then that. That's super cool, and that's interesting, but, you know, it's not there yet. And things like money movement between borders, like all this, that's also really useful. Specifically, we've seen, you know, with Latin America, where you can't really buy futures in fiat currency, but you can immediately send, you know, money in stablecoin. So that's some applications that are cool, but DeFi for now is a little bit nascent.
Okay. How about the next big trend, embedded? I mean, embedded is happening, obviously, so basically getting financed at the point where you buy something, like, and this is both, this is on the consumer side, can also be on the business side. Basically, if I buy a machine, it can be basically financed right away from where I buy it, or if I basically buy something for my stock, it can also be financed right away. Same with consumers, it then basically can be embedded. If I buy a TV set or do whatever, can be embedded directly. So do you see your business basically becoming more embedded over time instead of building a brand, so to say, and acquiring customers?
In our case, for example, we are also in point of sales, so we do embedded business for the e-commerce and also the hospitals or clinics where the people want to go, and there we offer our solution of loan solution of to get a loan from there, not only from our Loanbook but also from the marketplace. So I really believe in embedded. Now we've been talking about WeChat or Rappi in Latin countries, where with Rappi you can also do like everything, and it's really amazing, no? At the end of the day. So of course I really believe in this, and we will always be seeking for opportunities and trying to find what is best and what makes sense. No, I am like always thinking of the service that we are doing, and if it makes sense for the people and you make their life easier, and of course.
Yeah, well, I didn't know that you guys were doing that. That's really cool. I think that embedded is really the revolution, right? Like that is what's coming now, and what can really take a lot of the value away from the incumbents. And the reason why is because until now, you know, if we talk about non-embedded finance and lending, right, you need to go somewhere and get money, and then you decide what to do with it. So there's some aspect of our relationship and a lot of conscious choices on what do I do with this. I'm going to compare prices, and you're looking at the same product across the line. With embedded, you are accessing financing and funds directly tied to an action, right? Which means that there's no relationship really. Like anybody can do it. Instead of just being the CEO or the CFO making that decision, it can be anybody. You know, for example, we have a product that allows companies to offer terms to their buyers, right? To their customers. So then, if the customer chooses terms, that's not the CEO. That's like some finance associate or some person in charge of payables, and they click on a button, and that immediately triggers a financing tied specific to that action. So that is something that is really, really hard for an incumbent to develop. It's just like it goes against everything they've ever talked about, right? So that is what disintimidates them. And then, furthermore, you know, similar to what Lupino was saying, is when you build a vertical brand, then suddenly you have more data about that vertical than anybody else. So they know more about customers that have multiple bank accounts than any of those individual banks, which means that when you're embedded and you're offering finance there, you can offer better terms probably, you know, with more information, less risk, which means that you have an advantage of everybody else, right? So to me, embedded that is a true evolution that we're talking about here.
So do you think you can combine the two, basically, becoming an embedded player and also being on the customer forefront in terms of acquiring customer, building a brand and so on, to facing the customer, B2B customer or B2C customer? Do you think this?
I think so.
You can combine these two bundles?
I think so. It's part of the bundling that I was mentioning earlier, right? So you can do it, and you can embed your financing in workflows, either your workflows, the customer workflows, or third-party apps. For example, we have a partnership with Stripe. We are embedded in their dashboard, and whenever they sign up a customer, they can finance the whole value of the customer. And we do it directly as well, right? So for now, maybe it's like we're trying both, and then we'll decide for one, but I think it's possible.
We've run out of time.
So
we run out of time.
I just wanted to talk about buy now, pay later, but I think this maybe we do the next time then.
Yes, it will be great, but I know they're going to kill us.
Thank you very much. Thank you both.
Thank you. Thank you.